there, this is Sabina's Pan CPA of Base CPA Plus. We advocate less taxes and more profits. Now is September 2020. We have an election coming up in 2 months' time. And I'd like to discuss some of the tax implication of this event and like to prepare you for potential tax changes. It is impossible to be sure of anything but death and taxes. A famous line in The Cobbler of Preston by Christopher Bullock in 1716. This old adage is still true today, but there's actually a third certain thing in life, and that's fluctuating tax rates. The past 50 years includes a roller coaster of increasing and decreasing tax rates, depending on the budget needs of the country and the whims of the White House and Congress. Another major election coming up, combined with plummeting state and federal revenue because of this year's pandemic, could lead to higher tax rate in the near future. Now is the time to start thinking about how to structure your finances around higher tax rates. Here are some potential issues you could encounter if tax rates are increased, along with some helpful suggestions. The first is the estate tax problem. The federal estate tax rate for 2020 is 40% for the value of asset that exceeds $11.58 million and $23.16 million for married couple. States and Fed may drastically lower the threshold to tax more of your wealth when you die. They may also increase the estate tax rate over the current 40%. The solution is to create an estate plan or review your existing plan. Consider gifting money or security to family, friends, or a foundation during your lifetime. Individual gifts in 2020 of $15,000 or less, $30,000 for married couple, don't count against the lifetime gift-giving limit and excluded from the taxable estate. The second one is the capital gains tax. It may go up. In 2020, the highest long-term capital gain tax rate is 23.8%, with 20% highest plus the 3.8 surtax as part of the Affordable Care Act. In comparison, the highest rate was 15% back in 2005. Congress can use the long-term security and other assets as a valuable source of tax revenue by eliminating this preferential tax rate and instead using the ordinary income tax rate, currently as high as 37% on federal level and 0.3% in California, one of the highest tax states. The solution is actively manage investment profit using your gain against your losses. If you have any assets that have appreciated over time and you intend to sell them in the near future, consider trading in 2020 to avoid a potential increase in the capital gain tax rate. The third area you may see higher tax rates are the income tax. Given the increased government spending during the pandemic without corresponding tax receipts, most experts forecast an increase in overall income tax rates. The solution is an old standby in tax planning, which is shifting income and expenses. Say if you're owner of a private business, consider negotiating contract with customer to move income from 2021 into 2020. On the expense side, try to do the opposite by pushing as many deductions as possible from 2020 into 2021. For example, you could wait until 2021 to make any major capital acquisition. And finally, remember your tax defer account. If you plan correctly, you may have time to pay income tax on an account now and then move them into a tax-free Roth account. The bottom line, consider your situation now and create a tax strategy so that if or when tax rate goes up, you'll be as prepared as possible. Please reach out to our office and ask for a consultation. This is Sabina Pan CPA at Base CPA Plus. We advocate less taxes and more profit.